Something extraordinary is happening in the precious metals markets right now. Gold has broken through psychological barriers that stood firm for years. Silver is exhibiting volatility patterns we haven't seen since the financial crisis. And across trading desks worldwide, emergency signals are flashing. But here's what separates informed investors from everyone else. They know that moments like these require clarity, not panic. They demand strategy, not speculation. Today, we're going to cut through the noise together. I'm going to walk you through exactly what's happening in the gold and silver markets. We'll examine the forces driving these movements. We'll look at what history teaches us about moments like these. And most importantly, we'll develop a framework for making sound decisions in an environment where emotions run high and mistakes prove costly. This isn't about chasing returns or timing perfect entries. This is about understanding the game that's actually being played. Whether you currently hold precious metals or you're considering your first position, the next 25 minutes could fundamentally shift how you approach this critical moment. Let's begin. The signals emerging from precious metals markets aren't subtle. Gold recently surged past levels that technical analysts have monitored for months. Trading volumes have spiked dramatically. Institutional positioning has shifted in ways that typically precede major market movements. Silver, always the more volatile cousin to gold, has been moving in patterns that veteran traders recognize immediately. These aren't the gentle waves of a calm market. These are the sharp, decisive movements that indicate something fundamental has changed. But what exactly are these emergency signals? First, we're seeing unusual patterns in futures markets. The relationship between spot prices and futures contracts has deviated from historical norms. This spread tells us that market participants are pricing in significant uncertainty about future prices. Second, physical demand has diverged notably from paper market activity. Central banks continue accumulating gold at rates not seen in decades. Retail demand for physical coins and bars has surged in specific regions. This disconnect between physical and paper markets often precedes sustained price movements. Third, correlation patterns have broken down. Traditionally, gold moves inversely to real interest rates and the dollar. Recently, we've seen days where all these variables move in unexpected tandem. When established relationships break, it signals that new forces are taking control. These aren't the signals of a normal market correction or rally. These are the hallmarks of a structural shift underway. To understand what's driving these movements, we need to zoom out. The global economic landscape has transformed dramatically over the past several years. Sovereign debt levels have reached peacetime records across developed nations. Central banks have navigated between inflation concerns and growth fears with unprecedented policy tools. Geopolitical tensions have escalated in ways that directly impact trade flows and reserve currency dynamics. Gold and silver don't exist in isolation. They respond to these broader forces. Consider the fiscal position of major economies. Government debt to GDP ratios have climbed steadily. Deficit spending has become normalized across political spectrums. The mathematical reality of servicing this debt at higher interest rates creates pressures that markets are beginning to price in. When investors lose confidence in the sustainability of current fiscal paths, they seek alternatives. Precious metals have served this function for thousands of years. Now layer in monetary policy uncertainty. Central banks face an impossible trilemma. They need to maintain price stability, support economic growth, and manage massive debt burdens. Historically, when forced to choose, they've consistently chosen the path that erodes currency purchasing power over time. Markets understand this pattern. Smart money positions accordingly. Geopolitical fragmentation adds another dimension. The post-Cold War consensus around global trade and reserve currencies is fracturing. Nations are diversifying away from traditional reserve assets. They're rebuilding strategic commodity stockpiles. They're questioning arrangements that seemed permanent just years ago. Gold performs a specific function in this environment. It's the asset with no counterparty risk. It's valued across all cultures and political systems. It cannot be printed, debased, or inflated away by any single government. This is why central banks are buying. This is why sophisticated investors are repositioning. The emergency signals we're seeing aren't random noise. They're rational responses to fundamental shifts in the global economic order. History doesn't repeat, but it often rhymes. The precious metals markets have experienced several major bull and bear cycles over the past century. Each offers lessons for navigating the current environment. Consider the 1970s. Gold entered that decade priced at $35 per ounce, fixed by government decree. It ended the decade near $800, having increased more than 20-fold. What drove this extraordinary rise? The breakdown of the Bretton Woods system fundamentally altered gold's role in the global monetary system. Persistent inflation eroded confidence in paper currencies. Geopolitical shocks, from oil embargoes to Cold War tensions, drove investors toward hard assets. But the journey wasn't linear. The path from $35 to $800 included violent corrections, long consolidation periods, and moments when it seemed the rally had ended permanently. Investors who understood the fundamental drivers and maintained discipline through volatility captured extraordinary returns. Those who panicked during corrections or chased prices at emotional peaks often fared poorly. Now examine the period from 1980 to 2000. Gold declined from its $800 peak to lows near $250. For 2 decades, precious metals were dismissed as relics. Paper assets dominated. The prevailing narrative declared that central banks had conquered inflation and economic cycles. Those who understood that cycles are permanent while narratives are temporary positioned themselves for what came next. From 2001 to 2011, gold rallied from under $300 to over $1,900. Once again, the drivers were fundamental. Aggressive monetary expansion following the dot-com crash, the financial crisis of 2008, sovereign debt concerns in Europe. And once again, the path included significant corrections that shook out weak hands. The cycle from 2011 to 2015 saw gold decline by nearly 45%. The narrative shifted again. Precious metals were declared dead. Paper assets resumed their dominance. Central banks began normalizing policy, or so the story went. What does this history teach us? First, precious metals cycles operate on longer time frames than most investors expect. Bull markets can run for a decade or more. Bear markets can grind on for years. Patience isn't optional, it's essential. Second, the most significant moves often begin when skepticism is highest. The early stages of major rallies feel uncertain because not everyone sees what's coming. By the time consensus forms, much of the move has already occurred. Third, volatility is a feature, not a bug. Corrections of 20 to 30% can occur within longer-term bull markets. These shakeouts serve a purpose. They transfer holdings from weak hands to strong ones. Fourth, fundamentals ultimately drive outcomes. Prices can diverge from fundamentals temporarily due to sentiment, positioning, or technical factors. But over sufficient time, underlying economic realities reassert themselves. The emergency signals we're seeing today, echo patterns from these historical transitions. We're not seeing a simple rally or correction. We're potentially witnessing the early stages of a structural regime change. Understanding this context is crucial for making sound decisions in the weeks and months ahead. Markets are driven by 2 forces, fundamentals and psychology. We've examined the fundamentals. Now, we need to understand the psychological dynamics at play because this is where most investors make their critical mistakes. Human beings are not wired for successful investing. Our evolutionary programming optimized us for survival in an ancient environment, not for navigating complex financial markets. Consider the psychological journey of a typical investor during a precious metals rally. In the early stages, skepticism dominates. Prices begin rising, but most investors dismiss it as temporary noise. They remember the last bear market. They've heard experts declare precious metals irrelevant. They wait for confirmation before acting. As the rally continues, skepticism gradually transforms into curiosity. More analysts begin discussing the move. Media coverage increases. The investor starts researching, reading articles, watching videos like this one. If the rally persists, curiosity evolves into interest, then desire, then urgency. The investor watches prices climb day after day. They calculate the returns they've missed. Fear of missing out intensifies. This is the dangerous moment. This is when investors abandon discipline and buy emotionally at elevated prices, often near local peaks. They enter positions without proper strategy, without understanding their risk tolerance, without clear exit criteria. Then the inevitable correction arrives. Prices drop sharply. The investor experiences pain far more intensely than they experience the pleasure of watching prices rise beforehand. This is loss aversion, a well-documented psychological bias. Panic sets in. The investor sells at a loss, often near the bottom of the correction. They vow never to touch precious metals again, and they miss the next leg of the rally entirely. This cycle repeats across markets and throughout history because human psychology remains constant. Now consider the opposite scenario. The investor who bought years earlier and has seen their position appreciate significantly. They face a different psychological challenge. Greed whispers that prices will continue rising indefinitely. They consider increasing position size at precisely the wrong moment. They ignore risk management principles that would protect accumulated gains. Or alternatively, fear of giving back profits causes them to exit prematurely, abandoning positions before the fundamental drivers have fully played out. Both scenarios represent failures of psychological discipline. Successful navigation of precious metal cycles requires understanding and managing these psychological forces. You must recognize that your emotions are real, but your emotional impulses are often wrong. Fear is highest at bottoms when opportunity is greatest. Greed peaks at tops when risk is most elevated. You must develop a framework that removes emotion from tactical decisions. This means establishing position sizes, entry criteria, and risk management rules before emotions intensify. You must understand your own psychological profile. Are you prone to panic during volatility? Do you struggle with FOMO? Are you overconfident after winning periods? The emergency signals flashing in today's markets will trigger emotional responses. Recognize this, expect it, prepare for it. Your ability to manage your psychology may ultimately matter more than your analysis of fundamentals. If you currently hold gold or silver, you're facing critical decisions. The emergency signals suggest this isn't the time for complacency, but neither is it the time for emotional reactions. Let's establish a framework for existing holders. First, reassess your position size relative to your overall portfolio. Precious metals serving as insurance or diversification typically represent 5 to 15% of total investable assets for most investors. If your holdings have appreciated significantly, they may now represent a larger percentage than originally intended. This isn't automatically a problem, but it requires conscious decision-making. If precious metals now represent 20, 30, or 40% of your portfolio due to appreciation, you face elevated concentration risk. A sharp correction would significantly impact your overall financial position. You have several options. Rebalance back to your target allocation, selling a portion to lock in gains. Alternatively, maintain the position if you believe the fundamental drivers remain intact and you can psychologically tolerate increased volatility. There's no universally correct answer. The right choice depends on your individual circumstances, risk tolerance, and conviction in the underlying thesis. Second, implement downside protection if you haven't already. This doesn't mean selling your entire position at the first sign of trouble. It means having clear criteria for when you would reduce exposure or exit entirely. What would indicate that the fundamental drivers supporting precious metals have changed? A sustained period of fiscal discipline and reduced deficit spending, a resolution of major geopolitical tensions, a genuine return to sound monetary policy. Define your criteria now before emotions intensify. Some investors use technical indicators to manage positions. A sustained break below key moving averages might trigger partial profit taking. A breakdown in relative strength might suggest reduced allocation. Others focus purely on fundamentals, willing to tolerate significant volatility as long as underlying drivers remain intact. Choose your approach consciously. Mixing methodologies randomly often leads to poor outcomes. Third, consider your physical versus paper allocation. The emergency signals we're discussing partly reflect divergence between physical and paper markets. Physical metal provides ultimate security and eliminates counterparty risk. But it carries storage costs, lacks liquidity, and can be difficult to sell quickly at fair prices during market stress. Paper exposure through ETFs or mining stocks provides liquidity and ease of trading, but it introduces counterparty risk and doesn't provide the same insurance properties as physical metal. Many sophisticated investors maintain both, a core physical position for long-term insurance and paper exposure for tactical trading or increased leverage to price movements. Fourth, avoid the temptation to become over-concentrated after successful periods. You've been right so far. Your positions have worked. This creates psychological conditions ripe for overconfidence. The investor who turns a well-sized precious metals position into their entire net worth has transformed diversification into speculation. They've abandoned risk management precisely when it matters most. Successful investing requires surviving to play another day. Concentration that eliminates diversification puts survival at risk. Fifth, consider tax implications of any adjustments. In many jurisdictions, precious metals are taxed as collectibles at higher rates than other capital assets. Understand the tax consequences before making changes. Sometimes, the optimal strategy from a pre-tax perspective creates suboptimal outcomes after taxes. Finally, resist the urge to constantly tinker with positions. Every trade carries costs, spreads, commissions, taxes, and most importantly, emotional energy. The investor who trades frequently in response to daily price movements almost always underperforms the investor who maintains a disciplined, patient approach. You've made it this far. You established positions before the crowd arrived. Don't squander that advantage through undisciplined behavior now. If you don't currently hold precious metals, but you're considering entering after seeing these emergency signals, you face a different set of challenges. The fundamental question is this: has the move already left you behind, or are we still early in a structural shift? Nobody can answer this with certainty. But we can develop a framework for making sound decisions despite uncertainty. First, examine your motivations honestly. Are you responding to fear of missing out? Are you reacting emotionally to dramatic price movements? Or have you conducted genuine analysis that suggests precious metals deserve a place in your portfolio? If your primary motivation is FOMO, stop. This is precisely how investors buy high and sell low repeatedly throughout their careers. If you're responding to sound analysis of macroeconomic conditions, correlation benefits, or portfolio insurance needs, proceed thoughtfully. Second, understand that timing perfect entries is impossible. The investor who waits for the ideal entry point often waits forever. prices rarely return to levels that feel comfortable after significant moves have begun. This doesn't mean you should buy recklessly at any price. It means you should think in terms of building positions over time rather than making single, large commitments. Dollar cost averaging remains one of the most effective strategies for entering volatile markets. Commit to deploying capital over weeks or months through systematic purchases. This reduces the risk of entering entirely at a local peak. Third, start smaller than you think you should. Human psychology consistently drives us toward oversized positions when conviction is high. This feels right emotionally, but creates conditions for poor decision-making later. If you believe precious metals should represent 10% of your portfolio, start with 3 to 5%. Give yourself room to add during corrections without becoming overconcentrated. This approach provides psychological benefits that matter enormously during volatile periods. If prices decline after your initial purchase, you have dry powder to deploy at better levels. If prices continue rising, you have participation without excessive regret over imperfect timing. Fourth, decide between physical and paper exposure based on your specific goals. If you're seeking portfolio insurance against monetary instability or systemic risk, physical metal is essential. Accept the costs and inconveniences as the price of genuine security. If you're primarily seeking price appreciation or portfolio diversification, paper exposure through quality ETFs may serve your needs efficiently. Many new investors benefit from starting with paper exposure for ease of execution, then gradually building physical positions as they develop deeper understanding. Fifth, educate yourself beyond surface-level understanding. Don't enter significant positions based on a single video or article. Study the history of precious metal cycles. Understand the fundamental drivers. Learn to recognize your own psychological biases. The investor who builds knowledge before deploying capital makes better decisions than the investor who learns through expensive mistakes. Sixth, prepare for volatility. Precious metals, particularly silver, can move 5 to 10% in a single session. Corrections of 20 to 30% occur regularly within bull markets. If you will panic during normal volatility, you're not ready to invest in this sector. Seventh, ignore price predictions and targets. The analyst confidently forecasting gold at $5,000 or $10,000 is selling you certainty that doesn't exist. Perhaps those levels will be reached, perhaps they won't. Your strategy should function across a range of outcomes, not depend on specific price targets materializing. Finally, consider this perspective. If precious metals are entering a structural bull market driven by fundamental economic forces, the current prices may represent early innings. If instead we're seeing a temporary spike that will reverse, entering now creates risk of significant losses. You cannot know which scenario will unfold, but you can position yourself to benefit if you're right while surviving if you're wrong. This is the essence of sound risk management. Let me be direct about the behaviors that destroy wealth during precious metal cycles. First, over-leveraging your position. Some investors use margin or futures to amplify their exposure to precious metals. They reason that if gold is going to rise substantially, why not maximize returns through leverage? This thinking has bankrupted countless investors throughout history. Precious metals are volatile. Corrections happen suddenly and violently. Leveraged positions that would survive easily with proper capitalization get liquidated during normal volatility. If you cannot hold your position through a 30% correction without forced liquidation, you're over-leveraged. Reduce position size immediately. Second, chasing price momentum without strategy. Buying because prices are rising and everyone is talking about precious metals is not a strategy. It's a recipe for buying high and selling low. Every purchase should result from analysis and fit within a broader plan. If you cannot articulate why you're buying beyond prices are going up, don't buy. Third, abandoning diversification entirely. The investor who sells all their stocks, bonds, and real estate to go all in on precious metals has made a catastrophic error. Precious metals serve important portfolio functions, but they should complement other assets, not replace them entirely. Concentration creates risk that will eventually manifest in painful ways. Fourth, trading frequently based on short-term price movements. Daily or weekly volatility in precious metals is noise, not signal. The investor who buys on strength and sells on weakness repeatedly generates commissions and taxes while destroying returns. Successful precious metals investors think in years, not days. They tolerate volatility because they understand the underlying thesis requires time to play out. Fifth, believing you can time perfect exits. The investor who plans to sell right at the top is deluding themselves. Tops are only obvious in hindsight. Attempting to capture the last 10% of a move often results in missing the first 90% of the next move. Have rational exit criteria based on fundamentals or technical signals, but abandon fantasies of perfect timing. Sixth, ignoring the role of emotions. You will experience fear during corrections. You will experience greed during rallies. Pretending you're purely rational sets you up for failure. Acknowledge emotions. Prepare for them. Build systems that prevent them from driving decisions. Seventh, failing to secure physical metal properly. If you own physical gold or silver, security matters enormously. Storing significant holdings at home without proper safeguards invites theft. Failing to ensure metal creates risk of total loss. If your physical holdings are substantial, professional vault storage often makes sense despite the costs. Eighth, discussing positions publicly or with friends casually. Loose talk about precious metals holdings creates security risks and invites unsolicited opinions that can undermine your discipline. Ninth, believing narratives about inevitable price rises. Gold bugs who've predicted monetary collapse for decades exist in every market cycle. They've been wrong repeatedly. Perhaps they'll eventually be right, but basing your strategy on their certainty is dangerous. Markets can remain irrational longer than you can remain solvent. Never assume any outcome is inevitable. 10th, neglecting the rest of your financial life. Precious metals are one component of comprehensive financial planning. The investor who obsesses over gold prices while neglecting career development, business opportunities, or skill acquisition has misallocated the most valuable resource: attention. Let's establish a concrete framework for managing risk during this period of emergency signals. Position sizing comes first. How much of your portfolio should be in precious metals? This depends on several factors: your age, income stability, risk tolerance, other holdings, and conviction in the underlying thesis. Conservative investors comfortable with modest returns might hold 5 to 10%. More aggressive investors with high risk tolerance and strong conviction might hold 15 to 25%. Anything beyond this starts resembling speculation rather than investment. Choose your allocation consciously based on rational analysis of your specific situation. Next, establish clear triggers for adjusting positions. Don't make changes randomly or emotionally. Define specific conditions that would cause you to increase, decrease, or exit holdings entirely. For example, I will reduce my position by 1/3 if gold falls below its 200-day moving average for more than 5 consecutive trading sessions. Or, I will exit entirely if inflation returns to the central bank's target range sustainably and fiscal deficits decline below 3% of GDP. Your specific criteria will vary. What matters is having them defined before emotions intensify. Implement stop losses thoughtfully. For paper positions, stop losses can protect against catastrophic declines, but set them wide enough to avoid getting stopped out during normal volatility. A stop loss 5% below your entry point in a market that regularly moves 5% in a session is guaranteed to get triggered at exactly the wrong time. If using stop losses, consider levels based on technical support zones or percentages that reflect actual market volatility, not arbitrary numbers. Diversify within precious metals if your allocation is substantial. Don't put everything in gold or everything in silver. Consider mining stocks for leverage to metal prices, while understanding they carry different risks than physical metal. No single form of exposure is perfect. Spreading across physical metal, ETFs, and quality mining companies can reduce specific risks while maintaining overall exposure. Rebalance periodically. If you've established target allocations, review them quarterly or semi-annually. When precious metals significantly outperform or underperform, rebalancing forces you to sell high and buy low mechanically. This removes emotion from one of the most difficult aspects of investing. Consider correlation with other holdings. Precious metals often move inversely to stocks during risk-off periods. This negative correlation provides portfolio insurance value beyond simple price appreciation. If your other holdings are heavily concentrated in equities, precious metals play a particularly important diversification role. Understand liquidity differences across exposure types. Physical metal cannot be sold instantly at precise prices. During market stress, spreads can widen dramatically. Mining stocks trade easily but can gap sharply on news. Structure your holdings to match your liquidity needs. Don't put money you might need within 6 months into physical metal. Finally, prepare psychologically for scenarios that challenge your thesis. What if you're wrong? What if the fundamental drivers you've identified don't play out as expected? The investor who has mentally prepared for being wrong makes better decisions than the investor who cannot contemplate this possibility. Precious metals don't exist in isolation. Understanding what's happening in broader markets provides crucial context for positioning. Equity markets are navigating their own complex dynamics. Valuations in certain sectors have reached levels seen only a few times in history. Concentration in a handful of mega-cap technology stocks creates fragility, yet earnings growth continues for quality companies. How do precious metals fit in this context? Historically, gold and stocks can rise together during periods of monetary expansion and economic growth. They can also both decline during deflationary crises or severe recessions. The emergency signals we're seeing in precious metals markets don't automatically imply equity market collapse, but they do suggest that smart money is hedging risks that equity-only investors may be ignoring. Bond markets tell another part of the story. Yield curve dynamics, credit spreads, and real interest rates all influence precious metals pricing. When real yields decline, gold typically benefits. When credit spreads widen, indicating stress in corporate debt markets, precious metals often perform their insurance function effectively. Current conditions show unusual patterns. Persistent inflation concerns despite central bank tightening, inverted yield curves that historically predict recessions, and sovereign debt concerns that haven't fully manifested in bond prices. These cross-currents create uncertainty that often benefits precious metals. Currency markets matter enormously. Gold is traditionally priced in dollars, so dollar weakness typically supports gold prices, while dollar strength creates headwinds. But recent patterns have broken historical norms. As we've seen periods where both the dollar and gold rise together, indicating that both are benefiting from safe haven demand relative to other currencies. This suggests currency debasement fears extend beyond just the dollar to fiat currencies broadly. Commodity markets provide additional context. Industrial metals like copper reflect economic growth expectations. Energy prices impact inflation dynamics. Agricultural commodities affect food security and social stability. When precious metals rally while industrial commodities weaken, it suggests financial stress rather than economic strength is driving flows. When both precious and industrial metals rise together, it often indicates broader inflationary or supply concerns. Real estate markets influence wealth effects and collateral values throughout the financial system. High property prices create wealth that can flow into various investments. Property declines create deflationary pressures and credit stress. During periods of real estate stress, precious metals historically perform their portfolio insurance function well. Understanding these broader market dynamics helps you interpret the emergency signals in precious metals markets. Are we seeing an isolated spike in gold and silver, or are these movements part of a broader risk-off repositioning? The answer matters for determining whether current levels represent entry opportunities or warning signs. We cannot discuss precious metals emergency signals without addressing geopolitics. The global order established after World War II is experiencing its most significant stress since the Cold War ended. Reserve currency arrangements are being questioned. Trade relationships are fragmenting. Military tensions have escalated in multiple regions. Gold has always performed a specific function during geopolitical stress. It's the asset that transcends national boundaries and political systems. Consider the current de-dollarization trend. Central banks across the developing world are reducing dollar reserve holdings and increasing gold reserves. This isn't happening because they believe gold will outperform financially. It's happening because they're reducing dependency on a reserve currency they no longer fully trust. When the central bank of China, Russia, India, or Turkey buys gold, they're making a geopolitical statement as much as a financial decision. This demand is structural, not cyclical. It doesn't depend on interest rates or inflation data. It reflects a fundamental reassessment of the global monetary system. Trade fragmentation creates another dynamic, supporting precious metals. As global supply chains fragment into regional or ideological blocks, nations rebuild strategic reserves of critical materials. Gold fits naturally into this trend as the ultimate strategic reserve asset. Military tensions in multiple regions simultaneously create uncertainty that typically drives safe haven demand. Whether tensions escalate or resolve, the uncertainty itself supports precious metals. Sanctions and financial weaponization have changed how nations think about reserve assets. When governments can freeze foreign exchange reserves or exclude counterparties from payment systems, assets beyond anyone's control become more valuable. Gold cannot be sanctioned, frozen, or excluded from any system. This property gains value as financial weaponization becomes normalized. The emergency signals we're seeing in precious metals markets partly reflect these geopolitical realities being priced in. Rather than predicting a single outcome, let's examine multiple scenarios and how to position for each. Scenario 1, sustained bull market. The fundamental drivers we've discussed intensify. Fiscal deficits remain elevated. Monetary policy stays accommodative relative to historical norms. Geopolitical fragmentation accelerates. Precious metals enter a multi-year bull market similar to the 2000s. In this scenario, patient holders of well-sized positions capture significant appreciation. Those who entered during the emergency signals or shortly after participate in most of the move. Those who waited for certainty miss the best entry points. Scenario 2, sharp correction followed by resumption. Precious metals decline 20 to 40% from current levels, shaking out weak hands and resetting sentiment. Then, as fundamental drivers reassert themselves, a powerful rally emerges from the correction lows. In this scenario, investors with dry powder and discipline to buy during the correction achieve optimal outcomes. Those who panic and sell during the decline miss the subsequent rally. Those who hold through volatility without averaging down participate, but could have improved results. Scenario 3, extended consolidation. Prices trade sideways for months or years, frustrating bulls and bears equally. Volatility remains elevated but without directional trend. In this scenario, patient holders maintain exposure but don't see significant appreciation. Active traders attempting to capitalize on volatility mostly generate commissions and taxes. Those who maintain discipline eventually benefit if consolidation resolves upward. Scenario 4, bear market resumption. The fundamental drivers fail to materialize as expected. Fiscal discipline somehow returns. Monetary policy tightens successfully without breaking anything. Geopolitical tensions ease. Precious metals enter a sustained decline. In this scenario, those with disciplined exit criteria and stop losses protect capital. Those married to positions through denial suffer significant drawdowns. Those who avoided positions entirely preserve capital, but miss participation if the scenario proves wrong. How do you position for uncertainty across these scenarios? You accept that you cannot know which will unfold. You structure positions to benefit from scenarios you believe most likely, while surviving scenarios you consider less probable. You maintain exposure sized appropriately for your conviction and risk tolerance. You implement risk management that protects against catastrophic outcomes. You preserve dry powder to take advantage of opportunities if they emerge. You focus on what you can control: position sizing, entry discipline, exit criteria, emotional management. You accept what you cannot control: short-term price movements, broader market sentiment, unpredictable geopolitical events. One final critical concept before we conclude: patience. Precious metals cycles operate on time frames that test human psychology. Years can pass between major moves. Volatility during waiting periods can be extreme. Narratives shift repeatedly, creating doubt and temptation to abandon positions. Successful precious metals. Investors share one common trait: the ability to wait. They wait for proper entry points rather than chasing momentum. They wait through corrections that shake others out. They wait for fundamental drivers to play out over months and years, not days and weeks. This isn't passive patience born from ignorance. It's active patience born from conviction in analysis and discipline in execution. How do you develop this patience? First, invest only capital you can afford to leave alone for years. Money needed within months has no place in precious metals positions. Second, focus on fundamentals rather than price movements. If your thesis rests on macroeconomic drivers that take years to unfold, daily price changes are noise. Third, limit how often you check prices. The investor who watches tick-by-tick movements experiences emotional volatility that undermines discipline. Check weekly or monthly unless you have specific reasons to monitor more frequently. Fourth, maintain perspective on historical cycles. The price today matters far less than the price 3 to 5 years from now if you're investing with appropriate time horizons. Fifth, accept that perfect timing is impossible. You will likely not enter at the exact bottom or exit at the exact top. Trying to achieve perfect timing often results in missing the bulk of moves entirely. Sixth, use corrections as opportunities rather than sources of fear. When positions decline, ask whether fundamental drivers have changed. If not, volatility represents opportunity, not risk. The emergency signals flashing in today's precious metals markets will ultimately prove prescient or false. Time will tell. But your success doesn't depend on the signals being right. It depends on how you respond to them. Disciplined, patient positioning allows you to benefit if you're right while surviving if you're wrong. Emotional reactive behavior creates risk of significant loss, regardless of whether the signals prove accurate. We've covered substantial ground together. We've examined the emergency signals flashing in precious metals markets. We've explored the macroeconomic context driving these movements. We've reviewed historical cycles and the lessons they offer. We've confronted the psychological challenges every investor faces. We've developed frameworks for existing holders and potential investors. We've identified critical mistakes to avoid. We've discussed risk management principles and explored multiple scenarios. Now comes the most important part: what you do next. The information you've received today provides a foundation, but information without action remains theoretical. Action without discipline often proves destructive. Here's what I want you to take away from our time together. First, understand that we're living through a period of genuine uncertainty about the global economic and monetary order. The old rules are being questioned. New arrangements are emerging. This uncertainty creates both risks and opportunities. Second, recognize that precious metals serve important functions in portfolios during uncertain times. They provide insurance against monetary instability. They offer diversification from paper assets. They've preserved wealth across centuries of political and economic upheaval. Third, accept that you cannot predict precise outcomes or time markets perfectly. What you can do is position thoughtfully based on sound analysis, manage risk appropriately, and maintain emotional discipline through volatility. Fourth, commit to ongoing education. Markets evolve. Conditions change. The investor who learns continuously adapts better than the investor who acts on static knowledge. Fifth, Make decisions aligned with your specific situation. Your age, income, risk tolerance, and financial goals are unique. Strategies appropriate for one person may be completely wrong for another. Sixth, implement whatever decisions you make with discipline and patience. Half measures and constant second guessing undermine even the best strategies. The emergency signals we've discussed today matter. They reflect significant market forces and fundamental economic pressures. But they're signals, not guarantees. Your task isn't to predict the future with certainty. Your task is to position yourself intelligently for a range of possible futures while managing risk appropriately. Can you do this perfectly? No, nobody can. Can you do this well enough to protect and grow wealth over time while avoiding catastrophic mistakes? Absolutely. This is what separates successful long-term investors from everyone else. Not perfect knowledge, not ideal timing, not absence of mistakes, but rather sound frameworks, appropriate risk management, emotional discipline, and the patience to let rational strategies play out over appropriate time horizons. The markets will continue generating signals. News will create noise. Emotions will tempt you toward poor decisions. Your advantage comes from the clarity you've developed today, from understanding the forces at play, from recognizing your own psychological biases, from having frameworks to guide decisions when uncertainty peaks. Use this advantage wisely. The months and years ahead will test everyone participating in financial markets. Those who prepare mentally and strategically will navigate these tests far better than those who react emotionally. You now have the knowledge to prepare effectively. What you do with it determines your outcomes. Thank you for your time and attention today. I hope this discussion has provided genuine value as you navigate these complex markets. Stay disciplined, stay patient, stay rational. The emergency signals are real. Your response to them will determine whether they represent opportunity or risk in your specific situation. Make it count.